You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to yet another episode of the Young Investors Podcast. We're back. Oh gosh, Hamish, boy, do we have some exciting news coming up that we can't quite share yet, but no. Oh my golly gee.
Yeah, I know.
Just talking about it off air. Sorry to be the ultimate tease, but
it's an exciting time of the year. Yeah, it's great.
It is.
Yeah, we can't really say too much yet at all.
No,
so
but get excited. Just gonna throw that out there. Get excited. We'll have some very exciting news probably in the next 2 weeks, maybe. I would expect in the next 2 weeks.
Yeah, a couple of weeks.
That's going to be cool. Yeah, when we get the ultrasound results. Yeah.
Oh dear, who's pregnant, me or you?
I don't know. We both can be.
Oh dear.
Oh gosh, I'm not opening that can of worms.
No, I'll be honest. I'm running on fumes today because my dog's been a bit sick, so I've been up all night, kind of just looking after her. So I'm a little bit tired, so I'm a little bit foggy. But the good news is that I was able to, because I was awake, go through the Daily Journal annual meeting, which happened at 5 a.m. This morning for us. So a lot of interesting stuff Mr. Charlie Munger had to say at the Daily Journal meeting, as he always does. So, yeah, I'm looking forward to going through it.
Was it CNBC? I haven't looked at it at all yet.
Yeah, CNBC. So Becky Quick doing her typical 2-hour interview with Munger. And, yeah, there was definitely some interesting commentary on China. He spoke about Elon Musk and Tesla. He spoke about Alibaba, had some interesting commentary there. So, yeah, a lot of interesting stuff to discuss.
Well, I'm going in blind. So you're going in blind to the 13F filings, which is what I'm going to be talking about.
Yeah.
And, you're going in blind to the 13Fs. I'm going in blind to what Charlie Munger was talking about. I tell you what, I reckon surely interviewing Charlie Munger has got to be one of the hardest jobs that exists, because he just, the way he answers things is just like, yes, because blah, 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 blah.
Yeah,
and he just
super
sits there in
blunt.
silence, like that's it. You're
Yeah.
Like, so my next question.
Yeah,
I reckon he'd be quite difficult, almost a little bit intimidating, maybe to interview.
Yeah, you'd have to always be ready with the next question. You don't have any chance to kind of look at your notes and get ready. But he definitely didn't change in this interview. He was very short and sweet with some of his answers, but still a lot of stuff to go through.
Yep. Answering like he's 99 and got better things to do.
Yeah, exactly. Exactly right. What else?
Also, one thing I wanted to follow up on. Did you see this comment? One commenter that we had on YouTube from the last episode said they thought that I was 5 foot, but they also have newfound respect for me being 6'3". Well, thank you. Although I do have to confess, I looked it up after because I'm not good with the centimeters to feet comparison, and maybe somebody already picked this up. I'm not actually 6'3", Hamish.
You liar!
I'm 6 foot 2.5.
Imagine you realize you're actually 5'3".
Oh dear.
No, that's crazy. 5 foot. Yeah, 5 foot would be. That's quite short.
Yeah. I'm not even the tallest guy in the office. JJ, how tall are you in feet? Do you know? 6'8". 6'8". JJ's 6'8".
Jeez.
He is a monster.
Yeah, that's getting up there. Jeez. You got some height on your team. You need some.
Yeah, I know.
You need to balance it out. You're going to have to hire someone who's like 4'8" now.
Nah, it's all right. Claude's pretty short. It's funny when Claude and JJ stand together.
Yeah, bit of a height difference.
Yeah. Anyway, that's enough talking about heights. Yes, so 13F season, we already spoke about what we're talking about today. Oh, there was also inflation data, wasn't there?
Yes. US inflation data kind of snuck up on us. I didn't even know that was out until I checked this morning. So, yeah, some further data to look at how prices are changing, How fun. But yeah, we'll take a look at that for sure.
Interesting. Yeah, I'm so numb to these inflation reports now. We've just covered so many of them now. Now that it's been a thing for like...
Yeah.
It's so funny. Inflation is just something that people never spoke about before, like last year. It's just like, oh, inflation, whatever.
Yep.
Well, not in the US anyway. There's plenty of other places around the world. But anyway. All right, let's get into it, Hamish.
Yeah.
Let's do it.
So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades by connecting your broker to Sharesight, or you can do it manually by downloading your trades using Excel or one by one. And when you do that, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, and you can track up to 10 holdings, stocks, ETFs, bonds, that sort of thing for as long as you want. Or you can sign up to a more premium plan for more features. And if you do that and you use that link, you'll get 4 months off a yearly subscription. So go check it out if you haven't already. And as always, thanks to everyone who has used that link when signing up and is supporting the podcast.
All right, 13F time.
13F time. Who we got?
Is that where we should start?
Yep. Let's start.
Okay.
Who's first up?
So we'll start with Buffett. Why not? Everybody loves Warren Buffett. So 13Fs, of course, it's 45 days, just ticked over 45 days after the end of the quarter. So 13Fs are out. That, of course, if you don't know, tells us what is in the stock portfolios of all of our big super investors that have at least $100 million in assets under management. So all the ones we follow, Charlie Munger with the Daily Journal, Corp, Warren Buffett, Michael Burry, Monish Pabrai, Guy Spear, Lee Lu, all those guys. They all release one. So we've got a few to talk about today. We will start with Warren Buffett. Got to remember that this is not the Warren Buffett 13F. It is the Berkshire Hathaway 13F. And there are 3 managers. There's Ted, Todd, and Warren. So we always have to think about that. I think there's 49 stocks in the Berkshire portfolio. So all that means basically is that if you want to look at what Warren Buffett's doing, you just got to look at the top end of the portfolio because Ted and Todd manage a lot less than what Warren Buffett does. So all of their positions are kind of at the bottom, and then Warren Buffett's positions are at the top. So I typically just look at like the top 10 to 15 holdings when it comes to the Berkshire Hathaway stock portfolio, because again, even if you look at it, that's like the vast majority of their portfolio. I figured out, I can't remember though, but like the top 10 stocks account for a massive percentage of their total portfolio. Anyway,
yeah, it's kind of strange to look at Berkshire's portfolio because you do want to look at those big ones, and those are the decisions being made by Buffett and maybe Munger there. But then you've got these new managers that manage such a small part of the portfolio, so all of their picks are kind of mixed in right at the bottom, and we don't really get a clear picture of what's happening, at least down in that part of the portfolio. So we can only really look at the top.
Yep. So with that said, in terms of like the top 15 holdings in the Berkshire Hathaway portfolio, 10 to 15, there's really, honestly, this is a boring quarter. I'm not going to sugarcoat it. There's not a huge amount that happened. There's probably 2 stories that we can really sink our teeth into. There were 2 considerable changes to the top 10 holdings. I'll talk about the first one, which last quarter in the 10th slot in the Berkshire portfolio was TSMC, Taiwan Semiconductor, just the largest semiconductor manufacturer on the planet. And they reduced Buffett, and I should say, it was only last quarter that Buffett added it to the portfolio.
Right.
So he bought it. It wasn't like he added it, like he added 20% to Taiwan Semiconductor or whatever. He bought it last quarter. And this quarter, he has done a complete 180 and he has reduced 86.19%.
Wow. So he's basically out of that then.
He's basically out. And when you see a reduction of that size, it pretty much means that he wanted to sell all of it, but because he's so big, he probably just wasn't able to physically do that by the end of the quarter. So he still had a little bit left over. Also, it could be that, or it could be that either Ted or Todd has a very small position in there as well. But that's unlikely because it was a new buy last quarter. So that was very interesting because this is very unlike Warren Buffett to go into something one quarter, flip around, and be jetting out of it the next. So honestly, I'm not particularly sure what the thinking is here. I can only really, a lot of the times we can look at what Buffett's doing and we go like, yeah, that makes sense. But this one, I'm kind of like, no, this one doesn't make sense. So I'm not entirely sure what's going on.
Well, sorry, go on.
Yeah, I was only going to say, like, the shares dropped 6% on the news that Buffett was getting out, which is the Buffett effect in reverse.
Yep, it's on the way in and on the way out.
Yeah. The only thing that I was thinking is that maybe Buffett saw, because there's been a lot of short-term kind of turmoil in the semiconductor space. Obviously, they all went up because there was such a shortage in demand, and now there was such a shortage in supply, I should say. And now there seems to be a shortage in demand because, the macroeconomic conditions are really forcing people to pull back on what they're buying. And what we have seen with a lot of these semiconductor businesses is that their clients are reducing or cancelling their orders for these semiconductors. For example, even last month, TSMC forecasted that their revenue could fall as much as 5% this quarter. Which is a very different story to if you rewound like a year or two ago. It was completely the opposite. They could do no wrong.
Yeah.
And that, they also noted that they could face weaker demand. So I don't know, did Buffett just make a mistake and they was just like, just say, you know what, this hasn't punished me yet. I'll just do a 180 and get out before it hurts me. I don't know. I really don't know.
Yeah, it'd be interesting to hear his commentary on that specifically, and maybe at the Berkshire meeting we'll get some answers to some of this stuff. But in the meantime, Munger did say a couple of things about Taiwan and about semiconductors during the meeting. So I was just rifling through the notes that I took to try and find it. He was asked about semiconductors specifically and around the political climate around Taiwan, and in classic Munger style, he gave a very short and kind of blunt answer. But his answer was on semiconductors that it's the kind of business where you take all the money that you make and you reinvest it all just to stay in the game. Typically, we hate those businesses. We want surplus. So he was essentially just describing that it is a very difficult business. And then he just quoted that, Intel was once the Taiwan semiconductor of the world. It used to be dominant. And now very quickly, or at least in his view, they're falling behind. So yeah, that kind of falls in line with, I guess, what Berkshire has done with the company, which is at least Munger seems to believe just overall it's a bad business to be in. So maybe Buffett kind of followed in Munger's view of that now.
Right.
So yeah.
Right. No, maybe no obvious competitive advantages around. I don't know semiconductors at all.
Yeah.
But it sounds, well, the way it's certainly spoken about in the media is that it almost seems like they're a commodity. And we know that once you start drifting into commodities, there are no moats because you're all kind of making, of course, chips are different and whatever, but they're made in the same kind of process by the same kind of machinery.
Yeah.
Just tailored to each individual client. So it kind of is commoditized.
Well, especially if the innovation curve is slowing down, then there is very little advantage that different companies will have. There's no kind of scale advantage of being able to invest more into staying ahead and having the fastest chips. So that plays a considerable role as well. He was also asked about whether I think he was asked specifically about the company in Taiwan and whether this was related to the US-China relations. And he basically said no. He said that he doesn't think that China will go in and try and take over Taiwan. He said that the chance of a big confrontation with China has gone down due to what's happening in Ukraine. The Chinese leader is smart, a practical leader. Taiwan doesn't look like a cakewalk anymore. That helps people looking to invest in China. So that was his kind of commentary on Taiwan specifically as well.
Interesting. Okay, so that's TSMC. The other big thing to talk about from Warren Buffett's portfolio was a 12.35% reduction in Activision Blizzard.
Okay.
Again, it's reasonably un-Buffett-like. I'll get to why. So for those that need the fill-in, Microsoft is trying to acquire Activision Blizzard. So Buffett is not in Activision Blizzard because he loves the business and wants to own it for the long term. He's in it because it's turning into a potential arbitrage opportunity. So Microsoft is trying to acquire Activision Blizzard for $95 per share. That's in an all-cash deal which was announced last April. In December, the FTC filed an antitrust lawsuit to block the merger. The FTC said the agency alleges that the deal would enable Microsoft to suppress competitors to its Xbox gaming consoles and its rapidly growing subscription and cloud gaming businesses. So the FTC stepped in. I'm not an expert in these kind of antitrust cases for certain, but there are people saying, yeah, it's going to go through. There are other people saying, oh, no, probably not. So whatever side of the fence you fall on is up to you, I guess. But I find it interesting that he's just reduced by 12%. And it's interesting that he also reduced in Q3, he also reduced by 12%. He sold 8.26 million shares in Activision. So I'm trying to just think, like, why would he be doing this? And maybe you have a better insight on this than I do. But to me, is it just he feels like he's a little bit less confident in the merger just going through, so he just wants, like, he's still on balance, he thinks that it will go through, but he still wants to maybe reduce his stake and reduce the downside risk by just lowering his stake?
Yeah, I don't know.
I don't know.
I think it's hard to tell. I think it's difficult to tell when you have these trims, what's related to the actual investment itself, and maybe what's related to some kind of tax harvesting or some other kind of opportunity that he's found, some kind of short-term bond opportunity that might be him in the portfolio that we just don't see. So I think it's hard to say specifically unless there's a really significant move. But yeah, I don't really know. And we can't really look to Buffett's kind of what he said in the past because historically he's been the guy who doesn't trim positions. If he
doesn't trim,
if he falls out of favor with the stock, he's out. And if he likes the stock, he's basically all in. He'll invest heavily. So trimming is something that he's done. He's done it consistently over time, even though that's what he said at meetings. And so I don't really have any insights on specifically what that could be.
The only other bit of information I remember is that Todd. It was either Todd or Ted, I don't know which one, made an investment in Activision Blizzard at around this price, I think, as well. They made that investment not too long ago. So I think that maybe in the back of Buffett's mind, he's probably come to a similar conclusion and just been like, okay, well, if things don't work out, then I probably still hold a decent business at a decent price, because that's what Ted or Todd went into thinking. They didn't know that the Microsoft thing was going to happen when they made their investment. They were just buying the business for the business. So maybe there's an element of that he's not super stressed about selling all of it. Maybe he's just gotten a little bit less confident. I don't know. Anyway, moving on. You reduced US Bancorp by 91%, Bank of New York Mellon by 59%. So that's kind of been a trend the last couple of years. He's just gotten rid of the US financials, and he has continued to do that. Well, all the US financials except Bank of America, which he absolutely adores, which is currently his number 2 stock at 11.19% of his portfolio.
That's we got some commentary from Munger as well on that, so I can talk about that. The first question of the meeting was about Berkshire unloading the bank stocks, and less about that, but more about why Daily Journal didn't unload their bank investments. And why there's kind of a difference. And his answer, again, was pretty simple, but he said essentially the Daily Journal purchases were basically bottom tick purchases of the financial crisis. So they're almost all, it's just pure profit. And essentially, given the California taxes and some other differences between Berkshire and the Daily Journal's the taxes and dividends and that sort of thing, it was just worth holding on to them still. Like, they're still good businesses, essentially, was his answer. So he didn't really give a clear answer as to why Berkshire is actually unloading, just that they're still collecting large dividends, and for tax purposes, it wouldn't. They're not interested in offloading them and realizing those massive capital gains that have been kind of accruing for a decade. So that was his kind of answer on that.
That makes sense. Yeah. Okay. Really, apart from that, though, there was not much going on. They added 0.04% to Apple, so basically nothing.
Yeah.
They reduced Chevron by 1.44%, basically nothing. And then the rest is just not interesting. It's just so far down the list.
I'll add one that I saw was interesting in some ways and not in another. So Paramount, they added a small amount to the position, but Paramount represents 0.01% of the portfolio. So it's very, very small. But on the flip side, if we're looking at Paramount as a business, Berkshire now owns 15% of the company. So it is a tiny percent of Paramount, but clearly somebody, likely Ted or Todd, likes the business and has accrued quite a significant ownership in Paramount. It's a small company, so they can't really it doesn't make much difference to the overall business of Berkshire, but clearly they're very bullish on the investment because they own 15% of the company now. So it's just funny that you look at Berkshire's 13F and it's a tiny percent, and then but in terms of the company, it's like they've basically bought, as much as they could buy before they're starting to really force the stock up or just acquire it.
It's 0.53%
of
the Berkshire portfolio. Yeah, 0.53%.
Oh, sorry, yeah.
Yeah,
I was looking at the change.
But yeah, less than 1%. Less than 1%, yeah. Yeah, it is crazy when you talk in the numbers that Berkshire Hathaway's dealing in.
Yeah, it's almost like what's the point?
You could buy 100 businesses for less than 0.1% of their portfolio.
Yeah, I mean, if it goes to zero, it's not really going to make all that much of a difference.
Yeah. So that was Warren Buffett. What else we got to talk about? Li Lu, he added 168% to Apple. To Google. We'll try that one again. To Google Class A shares. So that was a big addition for Li Lu. Monish added Brookfield Corp and Brookfield Asset Management. Don't know anything about Brookfield.
There's a lot of value investors in those companies, and I saw it briefly there when I briefly looked at the 13Fs, I think yesterday, and it's something I'll probably take a look at over the next couple of weeks, and maybe I'll put a video together or something on it. But yeah, thus far it's not something I'm not particularly. Okay. I don't really look at asset management companies, but considering there's a number of value investors in it now, I'm happy. I'll be willing to look.
Maybe it's something going on there. So there you go. Guy Spear, he did nothing. Charlie Munger, he did nothing. Michael Burry, what did Michael Burry get up to? Just made recorded a video last night on Michael Burry. So he reduced 47% of his Geo Group position, which is the private prison he was in last quarter. He sold out of CoreCivic, which is another private prison operator that he had last quarter. Interestingly, he bought Chinese tech. He bought Alibaba and he bought JD.com.
Oh, there we go.
Yeah. So they both occupy 9% of his current portfolio each.
Right.
So he obviously joins the raft of value investors that own the Chinese tech companies.
Yeah.
So I was trying to think about why. I don't know. It's obviously still very much beaten down. The delisting risks I was looking up, they're now quite muted. They kind of sorted that out. The PCAOB is now able to check out the audit data for these Chinese companies, which is good.
Yeah.
Obviously, there's still a bit of worry on China's economy. A lot of the slowdown last year, there was a big economic slide. I think their economic growth slid from 8.4% to 3% in 2022 for China.
Wow.
Obviously, most of that's on the back of their COVID policies, but obviously there's still quite a few concerns about geopolitical kind of situation and also just reduced global demand for stuff at the moment, just due to the macro.
Yeah.
What else do I have to say? He did actually time them quite beautifully because both of these companies have just been on an absolute tear at the start of this year and even to the end of last year, I think. But there was a very obvious big dip in Q4 for both of them that I feel like he's probably just making a trade. Let's be real, it's Michael Burry, but
yeah,
he's probably just seeing that the stocks have just dipped very sharply, suddenly gotten in, and then what do you know? They've reversed their trend and have now been on a bull run. Yeah, so he's done very well.
He's been talking a lot recently about how today's market looks a lot like the early 2000s, and back then he was doing kind of very traditional Graham style value investing where sometimes he'd hold things for short periods and just realize the value and get out. But yeah, often he was holding stocks for a little bit longer than that. So, and that's certainly not something we've seen with Burry recently. I mean, every quarter it's a new portfolio. It's brand new. He sells everything, buys something new, and then does it all over again. Or he just has a portfolio of options, or he just has some weird stuff going on. So it'll be interesting to see if maybe he does start to build out some positions that we see stay in the portfolio for a little while. And these Chinese stocks could potentially represent some of that because they are good quality businesses. Munger on investing in China, he essentially said the same thing he's been saying forever, which is China has stronger companies and they're at cheaper valuations. So the risks, whatever they are related to the governance in China, is offset by the higher return that you get, both from them being cheaper and the business is performing better. So it's kind of a double-edged. You get kind of the best of both worlds. So that's interesting to see. But yeah, I'm curious to see if Burry holds on to a few things for a bit longer, because he did have a couple of value plays from the last quarter. Curate, I think, was one of them, and I think he sold most of it.
70%.
Yeah, so that was interesting to see. It hadn't performed that great since he bought it, so I would have thought he might have held some of those a bit longer, but there we go.
Yeah. So I think that they weren't massive positions, $9 million each. I think he manages upward of 160 million, but still interesting. His portfolio is only like 49 million at the moment, so he's got a lot of either cash or short positions or something else.
Yeah, he's got something brewing in the background.
there is definitely something.
He's got he's got some weird security in that portfolio.
Probably.
That's not on that's not listed.
Yeah. There'll be a movie about it one day.
Yeah, exactly. We'll see it in 5 years. We'll be like, that's what he's been doing. I see.
What else? I don't want to drag on too much with this because, you don't even know if these positions are going to stay in his portfolio by this time or even by now. Right now,
they're probably gone.
Maybe they're gone. They might already be gone. He took up a $5.2 million position in Coherent. I don't know much about this company. It's a $6 billion company listed on the NASDAQ. They actually changed their name last year. They were 26 Incorporated and they changed it to Coherent after making the acquisition of Coherent.
Right.
So their business is centered around three types of products: semiconductor production, networking equipment, and lasers.
Lasers. Oh, okay.
For all sorts of purposes: welding, medical, diagnosis, treatment, all sorts of stuff. Different types of lasers, which is kind of cool. Stock was down about 60% from its peak in 2021. That was when they actually announced that they wanted to buy Coherent. Their stock just went. But interestingly, he's probably sitting on about a 40% gain after buying it because it's just been on a tear. So very interesting. I don't know whether that's a short-term trade. I don't know whether it's a long-term play. I just don't know enough about that business, but I thought I would mention it anyway. His second biggest holding now, still behind Geo Group, is Black Knight, a $9.2 billion position in Black Knight. So this business provides software that allows banks and mortgage lenders to streamline the home loan process. So their software basically helps to manage and process loans, handle customer documents and information, and also it's a platform that makes sure everything is done in a compliant manner and is secure. They also have an analytics platform, property analytics platform that they sell, but I think that's a lesser part of their business. And this is interesting because this is, again, one of the Warren Buffett workouts, the arbitrage kind of opportunities, because Intercontinental Exchange is currently looking to acquire Black Knight. So they've committed to buying Black Knight at $13.1 billion. It's currently at $9.2 billion market cap. But currently, I guess overall, so there's a potential for a 32% upside if the deal goes through. But currently the deal is like Activision Blizzard is being held up by regulators who have expressed concerns over antitrust.
Interesting.
The resolution is expected in the middle of the year, so I would expect Michael Burry to hold this through to fruition unless he just makes a killing and it's just like, not worth the risk of it not working out.
I'd be really interested to have a long discussion with someone who makes these kinds of trades regularly and how they assess the likelihood of them going through, whether it's
Yeah.
It's a, you know, is this a small bet in the? I think it's a large position in his portfolio, right? Is it this?
Oh, it's his second largest.
Yeah.
But
So
remember, his portfolio is still only 47, 49 million out of the 160 something that it was like 3 quarters ago or something.
Yeah. I mean, I'd be so curious to know if assessing the likelihood of the deal going through is a part of it, and how that process looks, or whether there's some other kind of decision that's involved in this. I'm really curious. Is it? Yeah, I have no idea how you would even begin to go through this process, except maybe looking at similar cases and whether there's a large majority that ultimately were decided in the favor of the company. I don't know. But it would be interesting to talk to someone about that.
Yeah,
because I have no idea.
You'd really need to know like how the FTC works, what they're trying to achieve, what their focus is from higher up. You know, what do they need to? It's kind of like what we're talking about with ASIC and stuff. Like how does ASIC think about things?
Yeah.
What are they trying? What are they trying to do? What are they trying not to do? That sort of thing.
Or the judge.
Yeah, well, hey, mate. Barry. Oh, are you on that case? Oh. Look, I haven't seen you in a while. You want to catch up over drinks on Friday night? Yeah?
Yeah. Check Burry's calendar. Who's he been meeting for lunch?
I don't know. The guy gets investigated by the FBI already, so... all right, Hamish, that's all I got to talk about for 13Fs.
All right.
Only half the podcast.
Well, this podcast is basically half the 13Fs, half the Charlie Munger Daily Journal meeting. So,
tell me about Charlie. What's going on?
So we had the annual Daily Journal meeting, which happened, which essentially is 5 minutes of them doing their annual meeting, and then 2.5 hours of a nice Q&A session with Mr. Munger, where we get to kind of hear all kinds of answers from Munger about investing and his life principles and all kinds of things. And there was a lot of interesting points that were discussed. I spoke about a couple of them already, kind of as you were going through the 13Fs, but I'll see what else we got here. So ChatGPT came up pretty early, which I thought was interesting. He was asked about the impact of ChatGPT and AI on the Daily Journal business and just businesses at large. He said AI will continue to be really important for businesses, but there is a lot of crazy hype on the subject at the moment. And he essentially said it won't do everything, and a lot of it is nonsense. And to that, I probably agree with him that there is quite a bit of hype, at least at the moment, around this sort of stuff. It's very exciting, but there is so
many news articles being written about it. It's just like everywhere, and all the AI stocks have gone up and blah, blah, blah. It's just like this one thing happens, and then all the analysts at Wall Street go, oh, look at that, we better start investing in AI.
So Bing's kind of introduced portions of ChatGPT now into their platform, and I've seen some videos where people have had this kind of closed beta testing at the moment, and some people have been using it, and it's looked really impressive. And then I've seen other bits, and it's just falling apart with some very basic requests. So yeah, it's certainly still very early stage. It's some questions you'll be blown away by the answers, and others, like someone was looking up on Twitter, was looking up different financials for a company, and it just got every single number wrong. So it's not going to be great. It's not great so far at doing some things, but it is interesting, that's for sure.
Yeah, sorry, I'm distracted. I was just looking at Bing.
Yeah, so you can join a wait list.
Plan me a workout for my arms, abs, with no sit-ups and no gym equipment. And sure enough, it's worked exactly like ChatGPT.
Yeah. Yeah, it is fascinating, and hopefully it's I think we spoke about this, I think, last week, which is that because it's a language model, you were saying that it just gives you so much confidence that it's correct when it may not be.
Yeah.
And
true.
And yeah, it's impressive. It spits out an answer that seems like it's done all the maths or whatever. But yeah, if it's getting a lot of things wrong, we've kind of got to keep that in mind, that it's, you've also got to check it yourself. don't just rely on its maths. But essentially, there was also a question that someone got ChatGPT to ask. So they asked ChatGPT, ask Charlie Munger a question. And the question was, what is the most challenging bias to overcome? And Munger said, the one factor that dominates bad decisions is denial. If the truth is unpleasant, the mind plays tricks on you. And he said his greatest example of denial is the investment management industry. Essentially, he said 95% of managers won't beat the indices, and they know this, yet they continue to charge fees to underperform the indexes. And he basically said they're going to continue to do it because they've got kids and they've got a wife and they want that new house. And it's just a form of denial that most of them live in, which is that they know that their business is selling advice that's bad or that performs worse than what could otherwise be achieved with an index fund. So I thought that was an interesting answer. From Munger, and he doesn't stray away from taking a pot shot at the traditional management industry. That's for sure.
Yeah, classic. He doesn't like him, but fair enough. I mean, I don't like him either.
Yeah, it's there's a lot of interesting characters in the investment management industry. We'll just say that. Probably, I think the most shocking thing that kind of came out of left field from this meeting was on Alibaba. He actually said, and I had to go back and listen to it again because I thought that I misheard him. He said it was the worst mistake he's ever made.
The worst mistake he's ever made.
That was word for word. And
he still holds it.
Yes. So interesting. He didn't actually say all that much beyond this. A classic Charlie Munger. He never explains what he actually means, but he said he got charmed with their position in the Chinese internet market, but didn't stop to think that they're still a goddamn retailer. It's still going to be a competitive business, not a cakewalk. And then later in the interview, he kind of went over it again and said again, he was overcharmed by Alibaba and that he overestimated the future returns of the company. So that gives us an indication that he probably still likes the business, but that he believes he's significantly overpaid for it, which is interesting. Yeah, interesting that he's, as you said, that he's still holding the company.
Third largest holding, 15% of the portfolio for the Daily Journal, 26 million.
Yeah, but yeah, he said it was the worst mistake he's ever made. So there you go. That's quite a statement.
That is quite a statement. Wowee. He was buying at like $230 a share. I think that's when he started buying.
Yeah.
I think my average is like 130. I think the stock sits at 100 at the moment.
Yeah.
So, yeah.
And he would have gotten a little bit back with his tax harvest that he did.
Of course.
But still, yes, he in hindsight, he's overpaid significantly to where the stock is. And look, maybe long term it'll turn out that today's price is absurdly cheap and his price is just cheap, right? And both work out. But he doesn't seem to believe that, at least.
That's a little bit my stance with these. I think if you're looking at these Chinese tech, you cannot invest with anything but a long-term mindset.
Of course,
you have to, because like what's happening in China, what has been happening in China, still going on. Macroeconomics, reduced demand for products and services. A lot of the products of the world come from China, so I think you've really got to go in with like, what's this business going to look like in 10 years time or 20 years time? I think that makes a little bit more sense. Maybe it makes things a bit clearer. But yeah, I think, you just have to, you can't expect to make 20% return in 3 months by buying a stock like Alibaba or Tencent or something.
No. I mean, given the volatility...
Even though that's probably exactly what's happened, to be fair.
Yeah, I think given the volatility of the relationship between the US and China, any short-term horizon is just plagued by just the chance that there's that relationship goes in a very bad direction. Kind of like when a few years ago when Trump was president and he was really going after China with the tariffs. We didn't kind of see that continue to play out for many years in a row. But if we had, then maybe we'd be in a different position today with those relations. So it's just so fragile. I think you've got to have that long-term perspective.
Alibaba is actually up 62% since October.
Yeah, I mean, what did it go down to, like $60
Since
a share?
November, or the start of November, rather.
Yeah, I mean, from its peak, it must have been down over 85% or something. I think at
that point,
absolutely got destroyed.
Yeah,
So
80%. Yeah,
yeah,
it did get destroyed. It's still down 66% from its peak.
yeah,
Yeah, crazy.
interesting.
All right.
Yeah.
Well, that's interesting. Charlie Munger, biggest mistake.
Yeah.
All right.
So
We shall see.
yeah, we'll watch what he does with that. He had a couple of questions around electric vehicles and Elon Musk and Tesla. He said that Musk is an intelligent person. He was asked about whether his takeover of Twitter is good or bad for America. And Munger just said, I don't use Twitter, which is fair enough.
Fair.
Yeah, it's not sure exactly why you would
honest.
ask that question to him. There's only really one answer he would have given for that. He did say, though, that Musk has done a good job with Tesla, just not as good as BYD, which is BYD is, of course, Munger's Chinese electric vehicle investment with Li Lu. He was also asked specifically about why BYD over Tesla, and he said, that's easy. In China, BYD is increasing their prices while Tesla has cut them twice. He said, BYD is so far ahead in China, it's ridiculous. And he said, BYD's manufacturing plants are as big as all of the land on Manhattan Island. So that kind of puts in perspective how significant BYD's operations are in China. But
Flawed logic, though. That last quote, definitely flawed logic.
yeah.
If you can churn out more cars in a smaller footprint, that's better than just being able to say, oh, look, we have manufacturing plants that cover more surface area than Manhattan.
Yeah,
Oh, okay, that means you've had to pay for more land, you've had to build more warehouses, you've had to tool more lines. It's like, flawed logic, because Tesla's strategy is obviously completely different. Get the most amount, increase the production pace in your lines as much as you possibly can, so you just don't need that kind of volume, that factory volume. But anyway, so definitely, Charlie, that was silly of you, mate. That's very obviously flawed logic on that last point. But the rest of it, we'll see.
Does Tesla make more cars in China than BYD? No, BYD is larger.
So. BYD deliveries, China.
Because I haven't looked at any of this stuff. So
I don't.
But I would presume by his commentary that BYD is significantly larger. But
it says, hang on, I'm just trying to find it. China ships 6.5 million units of new energy vehicles in 2022. Yeah, but what about BYD? What about BYD? No, I don't think I'm going to find it. Anyway, I'll have a look in the background. You
I'll keep going.
I'll have a look in the background.
He was asked why Berkshire sold BYD, but Daily Journal didn't. And he essentially said, we're not trying to be a mini Berkshire, so sometimes we'll do things differently. And then he went on to say that BYD is selling at 50 times earnings, so it's understandable that someone would want to sell at that valuation. So that gives you an interesting kind of difference in opinion between what to do when a stock gets to 50 times earnings. Charlie has had a long track record of not wanting to sell anything. If it's a great business, he's very happy to hold on to it. I'm sure I know he's not buying at 50 times earnings, and he doesn't want to overpay for businesses like that. But if he buys them cheap and they run up, he's very happy to hold them. The exact same thing is true with Costco, which is now sitting at 40 times earnings. He didn't buy it at 40 times earnings, but he's very happy to continue holding those businesses. So,
I found this. In December, BYD sold 235,000 vehicles in China. Of those, 122,000 were plug-in hybrids. Okay, so like half-ish plug-in hybrids. The rest were battery electric vehicles. Okay, so let's say 120,000 electric vehicles.
Right.
It sold over 900,000 of each type in 2022. Tesla made 55,000 battery electric vehicles in China last month, and a total of over 700,000 for the year. So 700 versus 900.
Okay, so they're pretty close.
Different.
Yeah.
They're not too different in terms of deliveries, but what they make per vehicle, I'm not sure.
Yeah. that's not something I've looked at.
Yeah,
so I'm not sure.
I need to go back over that. Anyway, sorry.
Yeah, so that was basically it on BYD. He was asked about, someone asked what could breach Costco's economic moat. And he said, as long as they keep their culture and low markups, there's no stopping it. That, I think feeds into the whole idea of scale economies shared, which is that they've got this scale, and if they just continue to under markup every company, then even if other companies with smaller scale used the same markup, they would be making far less profit than Costco. So Costco is in this very unique position where if they just continue to deliver their additional economic benefit, their additional scale benefit back to customers in the form of lower prices, there's really no stopping them. He said the problem is, from an investment perspective, is that it trades at 40 times earnings. Otherwise, it's perfect and has a marvelous future, run by wonderful people, and he's never going to sell a share. So that was his commentary on Costco. And then on a similar vein around high-quality businesses, he was asked why Benjamin Graham never evolved into high-quality businesses like Munger has been buying for most of his life. So, you have kind of Benjamin Graham's net deep value kind of process, and then that's how Warren Buffett got started. And then over time, Buffett switched into high-quality businesses, and a lot of that was influenced by Charlie Munger and Phil Fisher. What he said essentially was that Graham's rise was when there was a lot of low-hanging fruit among mediocre businesses that were way too cheap, but that the low-hanging fruit eventually went away. So that's kind of his thoughts on kind of the deep value process. And then interestingly, he said Graham actually made more than half of his money in one stock in the end, and that stock was Geico, which was ultimately a great business. And he said, essentially, the process that he taught is not how Graham actually made most of his money, which is kind of an interesting kind of twist on like the whole, it's kind of coming full circle in that at the end of the day, what made Graham the most money was the compounding of the one, high quality business in his portfolio, which was Geico. So I thought that was interesting to hear his perspective. I don't think I've heard him answer that question quite before. And it definitely gives you an insight into why Munger is so, and has been his whole life, passionate about the idea of high quality businesses, buy and hold, over, buying into these kind of mediocre businesses that are just really cheap. So I thought that was interesting. He was asked about, and this is kind of the last point I've got here, asked about Disney and Paramount. Not exactly sure why he was asked about Disney, except that maybe because it's been in the headlines recently. And then Paramount was about because Berkshire owns 15% of Paramount now. On Disney, he said, every business that Disney owns has gotten tougher. ESPN used to be a gold mine. Now it's a difficult business. And unfortunately, that's just what happens in business. He also said, when a new technology comes in, it's often the incumbents or the legacy businesses that mess up the shift. And he kind of gave an example, which was IBM, which for most of his life has been a company that has been admired. And then the last 10 or 15 years in the internet age, they've kind of fallen quite behind some of the other big computer companies. And then on Paramount, he said, in terms of why Daily Journal hasn't invested in Paramount, but Berkshire has. He said he's avoided the movie business as investments his entire life. He doesn't like the unions, the agents, the lawyers, the movie stars. That's not his culture, or that's not my culture, is what he said. And then he said that the movie business has always been very hard for people who put the money up, the investors. So it's always been a business that's good for the actors and the people participating in it, but the people who are investing, it's always been very difficult. So that's kind of his perspective on Paramount.
Nice. A lot of good topics covered.
Yeah, really interesting. I think a lot more, and there was a lot more. I cut out the crypto stuff because it was rinse and repeat from every previous year, and there was a couple other topics that I didn't get to. So I encourage anyone who wants to see the full interview, go check it out. It's I think it was unlisted on CNBC, so you kind of have to Google search for it, go through the CNBC website, and then you'll find it. But
do you have a link? Can you just post it to me?
I don't have it right here, but I'll
That's all right.
Yeah,
dig it up later.
Yeah.
All right, very cool. I'm keen to go and watch that now. But let's talk about how long we got. We got 10 minutes, Hamish. So let's talk about US inflation.
US inflation.
What happened?
So Yeah, so things have gotten a little bit worse. Not too bad, but not as good as last quarter. So
A little bit worse.
Yeah, a little bit worse. Inflation in January rose 0.5%, which was a lot faster than the 0.1% increase from last month. So a bit of an increase in the pace to start 2023. The annual inflation figure did continue to decline, though. So the annual figure is now 6.4%, down from 6.5%. Although notably, the rate of that decline is starting to slow. So we're kind of the month over month rates is where we're at in terms of the annual rate now. Food and energy both rose pretty considerably in January. Food was up 0.5% month over month. Energy was up 2% month over month. And that's a bit of a shift from the last few months where energy has just been consistently going down. And that's been kind of driving this decrease in inflation. Mm-hmm. Core inflation, which excludes food and energy, was 5.6% year over year. On a month over month basis, it was up 0.4%, which is basically the same it's been for the last few months. So core inflation has been very, very consistent and kind of holding up in a way. Within that, there's shelter, which was up 0.7%. And a lot of that is kind of home price increases and rental increases being passed through by homeowners. Rising prices also meant that it was a loss in real pay for workers. So average hourly earnings fell 0.2% for the month, and in total is now down 1.8% for the year. So nominal wages are up, but once we take into account inflation, in real terms, people are worse off. The Fed has a new figure that they've kind of started talking about in the last couple of months. Which,
oh my gosh!
They always have a new figure, right?
Is it the transitory inflation figure?
No. But yeah, that'd be interesting to hear that come back though. Transitory interest rates. No, but so we've got the inflation figure, we've got core inflation, which removes the food and energy, and now we've got super core, which super. Oh my God. Which is
super core.
And to be fair, there's actually it seems like a rational reason to talk about it.
Super core.
So the super core
inflation coming to a Xbox near you.
I don't know about that name. It's essentially the core inflation figure, but also excludes shelter. So now they're excluding the next thing that's going up a lot, which has been home prices. But the reason for it is that they seem to have very strong reason to believe that home prices are going to fall later in the year. So they think that there's shelter that's in the inflation figures right now is just not going to represent really long run inflation or where inflation is heading, which seems to make sense, especially given the interest rate increases. That's what you would expect to see play out, although we never really know until it happens. But at least that's their argument. The super core inflation figure rose just 0.2% in January and was up 4% year over year. So yeah, of course, the figure that they care about most is the best looking figure, as always. But whichever way you slice it, inflation is still meaningfully above 2%. So more rate hikes are likely to be coming, unfortunately.
Yep, would expect that. Next, they're going to come out with super duper core inflation, which will be negative 10%. Yeah. Oh my gosh. We need to stimulate. Quick, guys.
Minus food, minus energy, minus shelter, minus transport, minus used cars, minus retail. It's just minus everything.
Literally everything.
And it came in at nothing. There's no inflation.
It's deflation.
If we remove everything, there's no inflation. Oh my God.
Yeah, basically. Dear, oh dear. But yeah, I think you're right. I wonder when the next Fed meeting is. I don't know. Do they do one in? Have they already done one in February? February? I don't know. There'll be one coming out in a little while.
Yeah, I think there should be one in the next week or so. Actually, no. It was at the start of February was the last one. So it'll be the start of March, I believe.
Yeah, except they're not always perfect.
No, they do. I think they do 10 meetings a year or something like that.
10, in 12 months. So we've had the one which went from the 31st of Jan to the 1st of Feb.
Yep.
The next one is March the 21st to the 22nd.
Okay, there you go.
So there you go. So we'll have to wait a little while. All right, cool, Hamish. Thank you for that. All right, shall we do some Q&A questions?
Yeah.
To finish off the podcast. I don't think I had anything. Oh, I did have one thing actually, just really quickly.
Yeah.
The world's oldest Bible is going to go on sale at auction.
Wait.
In the next little while.
Wait, the world's oldest Bible. So the original copy, you mean?
I don't. Well, I don't know. The copy that exists, the oldest copy that we know exists.
The one written by God.
Look, honestly, when it comes to biblical texts, I'm not the guy. I'm not the guy. Guess how much they're expecting this world's oldest Bible to sell for at auction?
Can I get a estimate on when it was, how old it is, or do we not know?
It is a Hebrew Bible that's more than 1,000 years old.
God, that's got to be going for a lot. How's the condition?
Yes.
Is it mint condition? Is it? No, I'm just kidding.
Is it mint? It's actually still in the box.
It's unwrapped. It's
unwrapped. It's
still in the plastic from 1,000 years ago.
It's expected to become the most valuable historical document ever auctioned.
Oh, this has to be going for hundreds of millions then, surely.
Not hundreds of millions, but yes, millions.
Wow, really? Okay.
It's somewhere between 10 million and
give me
80 million.
52 million.
Yeah, 50 million is
it
what it's
actually
expected
50?
to sell for. 50, yeah.
That doesn't seem like a lot. That seems like
what? It's $50 million for a book.
This is a 1,000-year-old book, though. This is a really old book. That's so old. I don't know. I mean,
to the right person, I don't know.
I mean, it's
I don't know.
a Bible from 1,000 years ago. Like that's pretty crazy. I mean, I'm not even a religious person, but to me, that seems like it would be a pretty hard, like that would be very hard to find a Bible that old. Because obviously it's just been scribed over and over and over again over, thousands of years, right? A couple thousand years. So, I don't know. I feel like that would just be worth like $1 billion or something. I don't know.
Maybe to the right person. I mean, this is the thing with art and collectibles.
Yeah.
It's literally worth what the next person's willing to pay for it. So maybe to somebody it is worth that amount.
Well, we had NFTs go for $60 million this year. Yeah. I mean, like...
That's true. Wow. That's wow.
I mean, we really, like, we've got Bored...
Wow.
The Bored Apes market is bigger than 50 million. Like what world do we live in?
That's a weird...
Yeah, what's wrong with us? That's what I'm saying. I mean,
what is wrong with us?
I don't care if it's a Bible or just any book. A 1,000-year-old book that has to go more than a fake picture. Like, then we can't.
Than a JPEG of a monkey.
Yeah, that is completely worthless.
Man, crypto bros in the comments, they'll be hating us this week.
Yeah, sorry about that. Maybe give it 1,000 years.
Give it, maybe it'll be worth something in 1,000 years. Sotheby's in May will auction the so-called Codex Sassoon, which dates to the 9th century and bridges the discovery of the Dead Sea Scrolls and the modernly accepted form of today's Hebrew Bible. Quote, "It is a vital touchstone of human history," said Richard Austin, Sotheby's global head of books and manuscripts. He would say that, wouldn't he? He's trying to sell it. Yeah. It's expected to go somewhere between 30 and 50 million. In 2021, hedge fund billionaire Ken Griffin paid $43.2 million for a first edition copy of the US Constitution.
Yeah, so I mean, that's not even that old.
No. In 1994, Bill Gates paid $30.8 million for the Codex Leicester, a collection of scientific writings that contains drawings by Leonardo da Vinci.
Yeah, this is what I'm saying. Like, these aren't even that old. These are, a couple hundred years old. Yeah. We're talking about 1,000 years old. That has to be.
Yeah, just pay up, 20 million more,
how did they
10 million more.
How did they even make a book 1,000 years ago? I'd like to see it.
I don't know.
I've got to see a picture of this after this.
That's probably the same way. I don't know. How do they make parchment? I don't know what parchment, I don't know the process, but it's just, there was a picture. It just looks like a book made of parchment and just hand scribed.
Imagine just writing that out. Yeah, we got another sale. I'm pretty sure they weren't doing that, but he just finishes.
Hey, Jerry, no, Leo just bought that one.
Page 10,000.
How quickly can you make another one?
Oh, I've just spilled coffee on those pages. Could you do that again?
Oh no, the coffee everywhere. Oh my God. Start again. Jeez, that's pretty funny.
Come back a month later. Draw up the contract again.
Yeah, I don't know. How long would it take him to describe it? I don't know.
I don't know.
All right. Is that let's do one quick Q&A.
Sneak one in. Here's a quick one.
Should we? Yeah, sure. Yeah, why not?
Hello, question to you both. What do you think about Meta shares valuation today? Do you think it will fall again? Hot take from Brandon here.
I put this one in. I put this one in because unfortunately this is an example of a question that we just can't answer. It's first of all, we're not supposed to answer questions like this because the answer we give can be construed as financial advice, which we are not in the business of doing. But also, I think it highlights another thing that you really shouldn't seek out what other people think on valuation. You shouldn't seek out what people online think or influencers or whatever, what they think about different stocks and that sort of thing. I think at the end of the day, you've got to be able to, you've got to understand the business well enough to think about what you think the valuation will be. Will it fall again? Who knows? Who knows? I don't think that's quite the right mindset either, because you got to be thinking, do I want to own this business even if it does fall again? Even if it goes up 20%, if it goes down 20%, if it goes down 50%, do I want to own this business? So I do thank you for the question. Unfortunately, it's not one we can answer. But I think at the end of the day, that we've got good videos on kind of valuation metrics. We don't, obviously no one knows whether it's going to fall again. Who knows? Anyone's guess. But if you want to have a look at valuation and try and do it yourself based on your own kind of assumptions on growth and the quality of the business and that kind of thing, then we've both got videos that can help you do that. Yeah. I put one out just last week.
Yes, you did. Yeah. It was a good video as well.
Thank you, mate. Thank you.
All right. Couldn't have said it better
your
myself.
Thoughts on this?
There's nothing really I can add. That's pretty much word for word what I would say on this as well. So with that said, thanks everyone for tuning in and spending a little bit of your Saturday morning with us. And we'll be back next week. Thanks Brandon for joining me as always, and thanks to Sharesight for sponsoring. Head over to sharesight.com/young investors. Almost said Hamish Hodder there. Don't go to that link. Go to Sharesight. Sharesight.com/young investors. And thanks to everyone who supports the podcast. With that said, we'll see you guys.
Thanks, guys.
See you next week.